We are in debt a lot. You can't change that. We got a lot of debt. That means you either have to cut your spending or raise your earnings.
Our currency is crashing and will soon no longer be the world standard, which will be our greatest defeat, frankly, in 200 years. There will be no defeat like that. That will take us away from being even a great power.
There's a bigger crisis that's brewing right now that most people are not talking about. It's called a reverse market crash. That's a scary sight.
U.S. dollar just started to collapse. How will this impact you? What if Ray Dalio, Donald Trump, and Patrick Bet-David are all signaling an imminent crisis? And it's already underway. The U.S. dollar, long the backbone of the global economy, is now under immense pressure. This isn't just a distant concern. It's happening now, affecting your savings, investments, and daily expenses. The question is, are you prepared for what comes next? In today's video, we'll break down the factors behind the dollar's decline and, most importantly, explore how you can protect your financial future. As the global financial landscape shifts, staying informed and adaptable is essential for navigating the challenges ahead. If this content resonates with you, please like, share, and subscribe to Economy Explorer. Don't miss any part of this discussion. We'll provide the insights you need to make informed decisions and secure your wealth. Let's dive in by looking at the current situation of the U.S. dollar, a currency that once ruled global finance, but now faces threats that could shake its very foundation. 1. The current situation of the U.S. dollar. A legacy of dominance. For decades, the U.S. dollar has reigned supreme in the global financial system. It wasn't just a currency, it was the bedrock upon which the entire world economy was built. But how did the dollar achieve this unparalleled status? To answer that, let's rewind to the aftermath of World War II. The world was in chaos, and nations needed stability. Enter the Bretton Woods Agreement in 1944, where the U.S. dollar was established as the world's reserve currency, backed by gold. This gave the dollar a position of unmatched trust and security in global trade and finance. But as we'll see, the very factors that once made the dollar invincible are now contributing to its potential downfall. As the world rebuilt after the war, the dollar's influence only grew stronger. It became the currency of choice for international trade, foreign reserves, and even oil transactions, a phenomenon known as the petrodollar system. But here's where things get interesting. The dollar's dominance wasn't just about economic strength, it was also about geopolitical power. The U.S. used the dollar as a tool to exert influence across the globe. However, this very power is now being challenged as other nations begin to question the sustainability of a system where one currency holds so much sway. The rise of de-dollarization. But what happens when the world starts to look for alternatives? That's exactly what we're seeing today with the rise of de-dollarization. This term might sound like economic jargon, but its implications are profound. Countries like China, Russia, and even smaller economies like Iran and Venezuela are actively working to reduce their reliance on the U.S. dollar. They're doing this by boosting their own currencies in global trade, increasing their gold reserves, and even exploring digital currencies as an alternative. Take China, for instance. As the world's second-largest economy, China has been steadily pushing for the yuan to be used more in international trade. They've signed currency swap agreements with several countries, allowing trade to be conducted in yuan rather than dollars. And it's not just China. Russia has also been at the forefront, reducing its dollar holdings and increasing its trade in euros and yuan. These efforts are part of a broader strategy to insulate themselves from U.S. economic influence, a move that could have far-reaching consequences for the dollar's future. As you can see, this is more than just a theoretical shift. It's a real, tangible movement that is gaining momentum. But what does this mean for the U.S. dollar? Is it still as strong as it appears, or are these signs of deeper vulnerabilities? Stick around, because in the next section, we're going to delve into the economic and geopolitical factors that are eroding the dollar's dominance and what it could mean for you.
Cracks in the fortress, economic and geopolitical vulnerabilities.
So, why is this happening now? To understand that, we need to look at the cracks that have started to appear in the once mighty fortress of the U.S. dollar. One of the biggest factors is the U.S.'s own economic policies. With national debt soaring to unprecedented levels and political gridlock making fiscal policy increasingly unpredictable, global confidence in the dollar has begun to wane. Remember when we talked about the Bretton Woods system? Well, that system relied on trust in the U.S. economy's stability. But what happens when that trust begins to erode? Over the past few years, the U.S. has faced mounting challenges that have weakened the dollar's standing. The political polarization in Washington has made it difficult to implement coherent economic policies, leading to uncertainty both domestically and internationally. Moreover, the aggressive use of economic sanctions as a tool of foreign policy has alienated many countries, pushing them to seek alternatives to the dollar to avoid being caught in the crossfire. And it's not just the U.S.'s internal issues. Geopolitical shifts are also playing a crucial role. As emerging powers like China and India grow in influence, they are less inclined to accept a global system dominated by the U.S. dollar. These countries are not just seeking economic independence, they're also challenging the geopolitical status quo. The dollar, once seen as a symbol of stability, is now increasingly viewed as a potential liability in a multipolar world. The visual shift, the changing face of global finance. As we discuss these shifts, it's important to visualize what's happening on a global scale. Imagine a map of the world with countries like China and Russia highlighted as they carve out new trade routes that bypass the dollar. Or picture a graph showing the steady decline in the dollar's share of global foreign exchange reserves, once above 70%, now inching closer to 50%. These visuals help to illustrate the profound changes taking place beneath the surface of the global economy. The impact of these changes isn't just theoretical. They're being felt in real time. Countries are diversifying their reserves, companies are hedging their bets with other currencies, and investors are starting to question the long-term viability of the dollar. The global financial landscape is shifting, and it's happening faster than many anticipated. As we transition to the next section, think about this. If the world is gradually moving away from the dollar, what does that mean for the future of global trade and finance? And more importantly, how should you be positioning yourself in this changing environment? These are questions we'll tackle as we continue our journey into the potential consequences of a dollar collapse. 2. Factors contributing to the dollar's decline. The weight of national debt. Let's start with a simple question. What happens when a household continually spends more than it earns? Eventually, debt accumulates to the point where it becomes unsustainable. The same principle applies to countries, and the U.S. is no exception. Over the past few decades, the U.S. national debt has ballooned to over $31 trillion, a figure that continues to rise with no signs of slowing down. This growing debt burden has sparked concerns about the long-term stability of the dollar. Consider this. A significant portion of the U.S. debt is financed by foreign investors who purchase U.S. Treasury bonds under the assumption that the U.S. government will always be able to honor its debts. But as the debt continues to climb, these investors may start to question the U.S.'s ability to manage its finances. If confidence in the U.S.'s fiscal responsibility falters, it could lead to a reduction in demand for the dollar, causing its value to drop. But that's just the tip of the iceberg. The more debt the U.S. accumulates, the more it relies on borrowing to fund its operations. This creates a vicious cycle where more debt leads to higher interest payments, which in turn require even more borrowing. It's a precarious situation, and one that has many economists worried about the potential for a sudden loss of confidence in the dollar.
Geopolitical tensions and economic sanctions. Now, let's shift our focus to the global stage. Imagine a world where economic power is no longer concentrated in a single superpower, but is spread across multiple competing nations. This is the reality we are moving towards, and it's having a significant impact on the dollar. One of the key factors driving this shift is the increasing use of economic sanctions by the U.S. as a tool of foreign policy. Over the past few years, the U.S. has imposed sanctions on countries like Russia, Iran, and Venezuela, aiming to curb their political and military ambitions. While these sanctions have had some success in achieving their immediate goals, they have also driven these countries to seek alternatives to the dollar. For example, Russia has reduced its reliance on the dollar by increasing its trade in euros and yuan, while Iran has turned to cryptocurrencies to circumvent U.S. sanctions. The unintended consequence of these sanctions is that they have accelerated the process of de-dollarization. Countries that have been targeted by U.S. sanctions are now actively working to create a financial system that does not depend on the dollar. This is not just a hypothetical scenario. It's happening right now, and the implications could be profound. If more countries follow suit, the dollar's role as the world's reserve currency could be significantly weakened. But there's more to this story. The geopolitical landscape is changing rapidly, with emerging powers like China and India challenging the U.S.'s dominance. As these countries grow in influence, they are less willing to accept a global financial system that is dominated by the dollar. This shift in power dynamics is one of the key factors contributing to the dollar's decline, and it's a trend that shows no signs of reversing. The rise of alternative currencies. Here's another question for you. If the dollar loses its dominance, what currency will take its place? This is one of the most pressing questions in global finance today, and it's one that has no easy answers. However, one thing is clear. Several countries are making moves to position their currencies as viable alternatives to the dollar. China's yuan, for example, has been steadily gaining ground in global trade. China has signed currency swap agreements with several countries, allowing them to trade in yuan instead of dollars. This is part of China's broader strategy to internationalize the yuan and reduce its dependence on the dollar. Meanwhile, the European Union has been pushing for the euro to play a more prominent role in global finance, particularly in energy transactions. But it's not just traditional currencies that are challenging the dollar's dominance. Digital currencies like Bitcoin and other cryptocurrencies are also emerging as potential alternatives. Countries like El Salvador have even adopted Bitcoin as legal tender, a move that could signal the beginning of a broader shift towards digital currencies. While these alternatives are still in their early stages, they represent a growing challenge to the dollar's supremacy. As we've seen, the factors contributing to the dollar's decline are complex and interconnected. It's not just about one country's policies or one economic trend. It's about a global shift in how countries view and use currency. But what does this mean for you? How should you be preparing for a world where the dollar is no longer the dominant currency? We'll tackle these questions in the next section, where we explore the potential consequences of a dollar collapse and how you can protect yourself from the fallout. Economic shocks and market reactions. Finally, let's talk about the potential for economic shocks to accelerate the dollar's decline. History has shown us that currency crises often happen suddenly and with little warning. A major geopolitical event, such as a cyber attack on U.S. financial institutions or a sudden shift in global trade patterns, could trigger a rapid sell-off of the dollar. If investors lose confidence in the dollar's stability, they may rush to sell off dollar-denominated assets, leading to a sharp decline in the dollar's value. But the real danger lies in the ripple effects that such a crisis could have on global markets. A sudden collapse of the dollar could lead to massive volatility in currency markets, with countries scrambling to protect their economies from the fallout. This could result in a global recession with widespread economic pain felt around the world. It's a sobering thought, but one that we must consider as we navigate the uncertain future of the global economy. 3. What happens if the dollar collapses? The initial shock: economic instability. Imagine waking up one morning to headlines declaring a sudden and severe drop in the value of the U.S. dollar. What would that mean for you? The immediate effect would be economic instability, not just in the United States, but across the globe. When a currency collapses, it triggers a domino effect that disrupts markets, raises prices, and creates uncertainty. The first shock would be felt in inflation. As the dollar weakens, the cost of imports, everything from electronics to basic goods, would skyrocket. This is because a weaker dollar means that more of the currency is needed to buy the same amount of goods from abroad. For Americans, this could translate into higher prices at the grocery store, gas pump, and beyond. In essence, your purchasing power would diminish overnight, and the standard of living could take a significant hit. But the impact wouldn't stop at inflation. Interest rates could also surge as the Federal Reserve attempts to stabilize the economy. Higher interest rates would make borrowing more expensive, affecting everything from mortgages to business loans. The resulting credit crunch could slow down economic growth, leading to higher unemployment rates and a potential recession. It's a scenario that could shake the very foundations of the global financial system. Global market chaos, the ripple effect. Now, let's broaden the lens. What would the collapse of the dollar mean for the global economy? The U.S. dollar is not just America's currency. It's the linchpin of the global financial system. Many countries hold large reserves of U.S. dollars, and international trade is often conducted in dollars. A collapse would send shockwaves through global markets, leading to widespread financial chaos. For countries that hold significant amounts of U.S. debt, a collapsing dollar would mean that their reserves suddenly lose value. This could lead to a sell-off of U.S. assets, further exacerbating the dollar's decline. Meanwhile, countries that rely on the dollar for trade would find themselves in a difficult position as their purchasing power diminishes and the cost of goods and services rises. In this scenario, global trade could slow down dramatically, leading to shortages, higher prices, and even geopolitical tensions. Imagine the world's largest economies scrambling to find an alternative to the dollar. The euro, yuan, or even digital currencies could rise to fill the void, but this transition would not be smooth. The uncertainty and lack of a clear replacement could lead to heightened volatility in currency markets, making international transactions more risky and less predictable. But the chaos wouldn't be limited to financial markets. The social and political implications could be severe as well. A global recession triggered by the collapse of the dollar could lead to increased poverty, social unrest, and political instability in many parts of the world. It's a stark reminder of just how interconnected the global economy truly is. The long-term impact: shifts in global power. In the long term, the collapse of the dollar could lead to a significant shift in global power dynamics. For decades, the U.S. has enjoyed unparalleled influence on the world stage, in large part due to the dollar's dominance. But as we've discussed, that dominance is now under threat. If the dollar were to collapse, it would mark the end of the U.S.'s economic supremacy and the beginning of a new era in global finance. One of the most likely outcomes of a dollar collapse would be the rise of alternative currencies. China has been positioning the yuan as a global currency for years, and a weakened dollar could accelerate this trend. The euro could also gain prominence, particularly in Europe and Africa. Meanwhile, digital currencies like Bitcoin could see increased adoption as people seek alternatives to traditional fiat currencies. But a world without the dollar at its center would be a very different place. The U.S. would lose much of its ability to influence global economic policies, and other powers would step in to fill the void. This could lead to a more fragmented and multipolar world where no single country or currency dominates. While this might seem like a positive development for some, it could also lead to increased competition and conflict between global powers. As we look to the future, one thing is clear: the collapse of the dollar would have profound and far-reaching consequences. It's a scenario that underscores the importance of understanding and preparing for potential economic shifts. But the question remains, what can you do to protect yourself in such uncertain times? 4. Impact on you and your investments. Your investment portfolio, navigating volatility. Imagine you're at a casino, placing a bet that has always paid off in the past. Suddenly, the odds change dramatically, and what was once a safe bet now seems like a huge risk. This is what it could feel like if the U.S. dollar collapses, and you're heavily invested in dollar-denominated assets. The first place you'll likely feel the impact is in your investment portfolio. For most investors, the U.S. dollar is a cornerstone of their financial strategy, whether through direct investments in U.S. stocks and bonds or through international investments that are valued in dollars. If the dollar loses value, the ripple effect could be significant. Stocks that are heavily reliant on imports would see their cost rise, cutting into profits and potentially driving stock prices down. Bonds, particularly those tied to government debt, could also take a hit as interest rates rise to combat inflation, leading to a decline in bond prices. But it's not just about the direct impact on your portfolio. A dollar collapse would also likely increase market volatility. As investors scramble to protect their assets, we could see dramatic swings in stock prices, creating a challenging environment for even the most seasoned investors. This could lead to a broader shift in investment strategies, with more people moving away from traditional dollar-denominated assets in favor of alternatives like gold, cryptocurrencies, or foreign currencies. However, it's important to remember that with every challenge comes opportunity. In a volatile market, there are always sectors or asset classes that perform well. The key is to stay informed and be ready to pivot your strategy when necessary. We'll discuss practical steps you can take to safeguard your investments in the next section. Everyday life, the cost of living. Now, let's bring this closer to home. What does a dollar collapse mean for your everyday life? Imagine going to the grocery store and seeing that the price of basic items like bread and milk has doubled or even tripled. This might seem far-fetched, but it's a very real possibility if the dollar were to lose significant value. Inflation would spike, and the cost of living would increase dramatically. This isn't just about luxury items or big-ticket purchases. The impact would be felt across the board, from groceries to gasoline to housing. For example, if you're renting, your landlord might raise the rent to keep up with rising costs. If you own your home, the value might decline, but the cost of maintenance and property taxes could rise as local governments scramble to fill budget gaps. Moreover, the impact of a dollar collapse would vary depending on where you live. In high-cost areas, the effects could be even more pronounced, leading to a potential migration of people seeking more affordable living conditions. This could reshape demographics in significant ways as people move to less expensive regions or even other countries. But it's not all doom and gloom. There are steps you can take to protect yourself from these rising costs, such as diversifying your income sources, investing in inflation-protected assets, or even exploring opportunities in the gig economy. We'll explore these strategies in more detail shortly. Savings and retirement. Safeguarding your future. Let's talk about the long-term implications for your savings and retirement. Imagine you've been diligently saving for years, only to find that the value of your nest egg has been eroded by inflation. This is a real risk in the event of a dollar collapse. Savings accounts, especially those with low interest rates, would struggle to keep up with rising inflation, leading to a loss of purchasing power over time. For retirees or those nearing retirement, this could be particularly devastating. Fixed incomes would buy less and less as prices rise, potentially forcing people to delay retirement or return to work. Even pensions and Social Security could be at risk if the government is forced to make cuts to manage its debt. The very foundation of financial security for millions of Americans could be shaken. So, what can you do? One strategy is to diversify your retirement savings into assets that tend to perform well during inflationary periods, such as real estate, commodities, or inflation-linked bonds. Another is to consider geographic diversification, investing in markets that might be less affected by a declining dollar. In the next section, we'll go into more detail on these strategies and how you can implement them. Financial planning. Adapting to a new reality. Finally, let's consider the broader implications for financial planning. The collapse of the dollar would force many people to rethink their financial goals and strategies. Traditional advice, like holding a significant portion of your portfolio in U.S. Treasury bonds or keeping a large emergency fund in dollars, might no longer be the best approach. Instead, financial planners may recommend more diversified global strategies. This could include holding foreign currencies, investing in international markets, or even exploring new asset classes like cryptocurrencies. The key will be flexibility, being able to adapt to a rapidly changing financial landscape. But adapting doesn't mean acting out of fear. It's about being proactive, staying informed, and making decisions based on a clear understanding of the risks and opportunities. In the next section, we'll discuss practical steps you can take right now to protect your wealth and ensure that you're prepared for whatever comes next. 5. What can you do to prepare? Diversify your investments, spreading the risk. Let's start with a story that might sound familiar. During the financial crisis of 2008, many people watched their portfolios lose significant value because they were too heavily invested in one asset class, U.S. stocks. Those who had diversified their investments across different asset classes, like bonds, real estate, or even foreign markets, fared much better. The lesson here: diversification is your best defense against uncertainty, especially in a scenario where the U.S. dollar is at risk of collapse. So, what does diversification look like in this context? It means spreading your investments across a variety of assets that aren't solely dependent on the U.S. dollar. Consider allocating a portion of your portfolio to foreign currencies, which could appreciate if the dollar declines. Gold and other precious metals are also time-tested hedges against inflation and currency devaluation. Additionally, investing in international stocks and bonds can provide exposure to economies that may be less impacted by a falling dollar. But don't stop there. Think about emerging markets and alternative investments like cryptocurrencies, which are gaining traction as digital stores of value. While these assets come with their own risks, they also offer potential protection against a weakening dollar. Remember, the goal is to create a balanced portfolio that can weather the storm, no matter which way the economic winds blow. Build up an emergency fund, your financial safety net. Imagine a scenario where inflation is rising rapidly and everyday expenses are skyrocketing. In such a situation, having an emergency fund is more crucial than ever. But here's the catch. A traditional emergency fund kept in U.S. dollars might lose value quickly if the dollar collapses. So, how do you prepare? One strategy is to hold a portion of your emergency fund in stable foreign currencies, such as the Swiss franc or the Japanese yen, which are less likely to be affected by a dollar collapse. Another option is to keep part of your savings in inflation-protected assets, like Treasury inflation-protected securities, TIPS, or even a portion in precious metals like gold, which tend to hold their value during periods of currency devaluation. Think of your emergency fund as your financial safety net. It should be accessible, secure, and able to maintain its purchasing power in times of crisis. By diversifying even your emergency savings, you're taking a proactive step to ensure that you can meet your needs no matter what happens with the dollar. Consider geographic diversification. Globalize your investments. Here's a question. If the U.S. dollar is at risk, why keep all your investments tied to the U.S. economy? Geographic diversification means spreading your investments across different countries and regions, reducing your exposure to any single economy's downturn. This is especially relevant if the dollar's decline is coupled with a broader slowdown in the U.S. economy. Investing in foreign markets not only provides exposure to different currencies, but also allows you to benefit from the growth of other economies that might be less impacted by a falling dollar. For example, consider investing in European or Asian markets, where the euro or yuan might gain strength as the dollar weakens. Real estate is another avenue for geographic diversification. Investing in property abroad can provide a hedge against a falling dollar and even offer potential income in a foreign currency. Just be sure to research the local markets and understand the risks involved. By thinking globally, you're not just protecting your assets from a dollar collapse, you're also positioning yourself to take advantage of opportunities in growing markets around the world. Stay informed. Knowledge is power. In times of economic uncertainty, staying informed is one of the most powerful tools at your disposal. The financial landscape can change rapidly, and being aware of the latest developments can help you make timely decisions to protect your wealth. But how do you stay ahead of the curve? Regularly follow financial news from reliable sources, particularly those that focus on global economics and currency markets. Subscribe to newsletters, attend webinars, and consider consulting with a financial advisor who has experience with international investments. The more informed you are, the better equipped you'll be to navigate the complexities of a dollar collapse. And don't forget to engage with your community, whether it's online forums, social media groups, or local investment clubs. Sharing information and strategies with others can provide new insights and help you feel more prepared for whatever the future holds. Reevaluate your financial goals. Adapt to the new reality. Finally, let's talk about your financial goals. A collapsing dollar might force you to rethink some of your long-term plans, whether it's retirement, buying a home, or funding your children's education. The key is to remain flexible and be willing to adapt your goals to the changing economic environment. For example, you might decide to accelerate your plans to invest in tangible assets like real estate or commodities, which could offer more stability in a volatile market. Or you might choose to prioritize investments that generate passive income, such as dividend-paying stocks or rental properties, to provide a steady cash flow, even in uncertain times. It's also important to consider how a dollar collapse could affect your retirement plans. You may need to adjust your saving strategy, increase your contributions to inflation-protected accounts, or even consider retiring in a country with a lower cost of living. Final thoughts. As we wrap up this deep dive into the potential collapse of the U.S. dollar, let's reflect on what we've uncovered. The dollar, once the backbone of global finance, now faces serious challenges: rising debt, geopolitical tensions, and the rise of alternative currencies. While this doesn't guarantee its collapse, it signals that we're entering unpredictable times. Think of the dollar as a ship navigating stormy seas. It has steered through rough waters before, but the challenges ahead require careful planning. As we've explored, preparing for these shifts means diversifying investments, building an emergency fund, and staying informed. Your ability to adapt will be your greatest strength in a constantly evolving financial landscape. If the dollar falters, the impact will be felt worldwide, but with uncertainty comes opportunity. This is your chance to rethink old strategies, explore new markets, and secure your financial future. The decisions you make now will determine how well you navigate the changes ahead. Thank you for joining us on this journey. Staying proactive and engaged will ensure you're ready for whatever comes next. If you found value in this video, please like, share, and subscribe to Economy Explorer. Together, we'll continue to uncover opportunities in this ever-changing economy.